Good afternoon, everyone, and welcome to this particular seminar on your way to financial success. Let me begin introducing myself. My name is Hrishikesh Prabhavalkar. I've been working with a leading brokerage firm for more than 10 years now, and I'm daily following the markets and trading the markets for around 10 to 11 years of time. Okay, friends, am I audible to all of you? Can you all please confirm that on the chat box? If I'm audible? Friends, am I audible to all of you? I would just like to get a confirmation, friends. Am I audible to all of you? Okay, that's great. That's great. Thank you very much. Now, let's begin with friends. Let us start today's session. Let's get started by looking at what are we going to be discussing today. First of all, let me share some key takeaways which we will have after this particular session. Since we all are basically from the finance background, so we are going to be looking at how to attain or how to achieve the financial success with the capital markets. We are going to be discussing that. After which, we are going to be discussing the major two ways by which we can do this. We can do it, and we can build our wealth from the capital markets. After that, I'll be talking about a myth which many of us may have when it comes to wealth building or achieving the financial success. And at the end of it, we are going to be talking about some secret to success which many of us know. Okay, we'll be discussing that in detail. Now, in a nutshell, friends, what I'm going to be doing today is you all might be knowing what to do in order to achieve the financial success. I'm going to be telling you how do we do it. Okay, so let's move on. And let us first start with those two ways which I told you, which we can use or which we can, which we can take help of for achieving the financial success. The first thing is investing, wherein we would be buying onto a particular stock based on its fundamentals, based on its future prospects and profitability and XYZ other things. Okay, and we'll be holding onto it for a longer period of time. And the second and not very talked about way is trading. Now, on this particular slide, I would only talk about trading in terms of trading is equal to buy and sell. We are going to be discussing that in detail a bit later. Now, I would also like to take a kind of poll here from all of you. What would be the preference of language? Can I continue with English, or would you require Hindi and English both? Can you please tell me that? English is okay. That's great. Thanks a lot. Okay, so let us move on, friends, and talk about these particular tool in detail, these particular ways in detail. So first, starting off with what is investing, then we'll also be comparing that with trading. So investing, if I have to tell you, it's just that it's buying and holding. Buy a particular security. It can be a stock which is listed in the equity markets, or it can be a commodity, it can be a currency, whatever it can be, whatever security it can be. If you want to buy and hold it for a real long period of time, investments are something which deal with longer term approach. So when I say a long term approach, I mean not in days, not in months, not in weeks even. I'm talking about something in years. So if you want to have something of say 5 to 10 years horizon, then investing is the best thing for us. Okay, and as an investor, it's like we are having our own business. Like if we start a business, if it's not working in a couple of months, we don't just close it. We just run onto it because we believe that whatever we did, whatever planning and studies which we did, based on that, this is going to give us benefit over a longer period of time. So that's like our own business. We become the part owner or the shareholders of the company, with which we would be getting voting rights of that particular stock. We would be also eligible for receiving the share in the profits, which is the bonuses or maybe the dividends, interim dividends and all. Okay, so it's like our own business. We are the owners of that company, and based on what we would be selecting in what stock or in what security to invest, It's based basically on fundamentals. We would have heard about fundamental analysis, which talks about the intrinsic value of the company by studying various things like what is the company's profitability, what is it going to be doing in future, how are it's going to be its order flows, and how the management is the management aggressive or is it a conservative management, and things like that. By looking at all these things, okay, we would be discussing, or we would be identifying a set of stocks which we want to hold in our portfolio for long term. I already have said that, I repeat myself, it's a long term approach wherein you want to do that for a period of not less than 5 to 10 years. Okay, so that's what is investing all about. We all would have heard about it before. Okay, this is just a kind of introduction for you. Now, I spoke to you something about trading some time back, and that time I said that trading is buying and selling. I would now rephrase it. I would say smart trading, when we talk about, it's about buying something lower and selling something when the prices go up. So when you buy lower and sell higher, that's what smart trading is all about. And as a trader, unlike that of an investor who is interested in looking at the fundamentals of the company, profitability, and etc. Okay, unlike that, as a trader, you are only interested in looking in the price of that particular security. You would buy a particular stock or a commodity or maybe a currency pair at an X amount of price, and you are only interested when the prices go up, you are interested in selling that at that price and then booking your profits or losses accordingly. So you are only interested in price. Now, since this is going to be related to only price, the basis on which you are going to be taking trades are basically sentiments, emotions. We all know that in markets there are three basic emotions: greed, fear, and hope. Right? So when we know that there is a bullish sentiment behind a particular stock, we would think of buying opportunities. When there is a bearish sentiment of a particular stock, we would look at selling opportunities. Okay, so they are basically based on sentiments. Now, when we talk about trading and investing, I would like to first clarify a myth when it comes to taking a trade. We all know that in order to build wealth, we need to have good portfolio, and I do believe that. Okay, we need to have strong portfolio which can give us returns over a longer period of time, which can build wealth for us. Okay, but there is a misunderstanding that trading cannot do that. It cannot be a wealth builder. Majority of us would believe that trading is nothing else but it's gambling. Correct me if I'm wrong. We all feel that trading is, at the end of it, it's a zero sums game. Sometimes you win, sometimes you lose, but at the end of it, you don't get anything out of it. Okay, but that's not the story, friends. I can tell you n number of people who have been wealthy by doing trading. I can just name few of them for the example purpose. Maybe it can be Mr. Richard Dennis, it can be Jesse Livermore, it can be Ed Secuta, it can be Bill Eckard, and so on and so forth. The list goes on. Okay, we all know about very good investors like Warren Buffett, Peter Lynch, and etc. But these are the traders also who have been making money only by doing trading, only by doing that smart act of buying lower and selling it at the higher rate. So trading is not gambling, provided you do it the way you do invest. You do invest by doing a proper planning and then you follow a proper process. In the same manner, if you do that same thing when you are trading, then trading is not gambling. Trading becomes gambling if it's just a guessing game for you. If you just think that the stock is going to go up, you just think that gold is going to go up, and you just buy it because of the news or because of some rumor which you heard from your friend or something like that, okay, then it's definitely a gambling. But when there is a proper process and planning is involved in this particular action, then trading is not gambling. Okay, now let's move on, friends, and talk about what are we exactly talking of. If I just compare trading with that of an investing, I will just show you a chart of ITC. This is a chart of ITC. Okay, and after adjusting to all the corporate actions like dividends and bonuses and all, okay, at 2009 levels, the prices the price for ITC was trading at around 20-30 rupees. Okay, and now the prices are close to 500 rupees. It's trading at its all-time high. Okay, now when we invest, let's say you did your study, you did your analysis, okay, at the time of buying that particular stock, this is a very good diversified company. It's into the FMCG business, it's into the hotel business, and this and that. By looking at that, you bought that stock in say 2009, and you are just continuously holding on to that stock till now. When it's trading near 500 rupees, it's gone up by almost, I would say, 150 odd percentage. Okay, more than that in fact. Okay, I'm not good at maths, but you're just buying onto it and you're just holding it, and with that what you want some interim dividends from the stock, you want some free shares when the company makes profits, and so on. So you're continuously holding onto that stock. This is what is investing. Okay, you select a particular stock which is good at fundamentals, good at financials, okay, and then you just buy that stock and hold it in your portfolio. Now if I compare that with trading, let's take the same chart of ITC. Now trading, what it means, I told you, it's buying lower and selling higher. With that proper planning and process, if you can judge that this is a proper bottom after which the prices are likely to go up, you buy at that lower rate. When the prices go up, you sell. Then you're anticipating the prices to go down. So as an aggressive trader, you can even sell out there, or you can just wait for the prices to come down. You can buy it back again. Once the prices go up, you again sell. When they again come back, you buy, and so on and so forth. Okay, that's what is trading and investing. Investing, you are interested in making some windfall gains by holding onto a particular stock over a longer period of time, provided that company is strong enough. Whereas trading, maybe it's the same company in which you want to trade, and your intention is to make those small returns. And in the bargain, friends, you actually can get a better potential, okay, when you are taking a trade. Because just think about it. You're buying something at 30 rupees and you're just holding on to it for 500. Now it's gone to 500. We are lucky enough. Your study was good. Your analysis was good. But just think of the other story. If it has not been good, then what would have been the story? You would have been still waiting in a loss. Whereas in trading, you would buy once it goes up as per your target, as per your plan. Okay, you sell that. When it comes down, you buy it back, and so on. Okay, so it has a better potential. It comes with an added advantage of a short-term liquidity. What I just now said, let's say 2008, many of us would have followed the markets, and many of us would know that there was a real big turmoil in the global markets in terms of subprime crisis, because of which all the big markets, including the Asian markets and Indian markets, okay, have crashed by more than 50-60%. So let's say you have invested around, say, 1 lakh rupees at that point of time. Okay, with that fall, it was nothing wrong with the company. Maybe the company like ITC, or maybe Tata Motors or SBI or whatever, okay, good companies. There was nothing fundamentally wrong in that company, but just those sentiments, those bearish sentiments globally, okay, took the company on the lower side. In that case, you don't have anything to take your money out from the markets. Just say, God forbid, you require money, okay, you can't touch that, because if you touch it, then you would be actually booking a loss. But in trading, as I told you, you buy ITC at say 40 rupees. Once it goes to 80 rupees, you sell it off. That 40 rupees profit you can actually encash in between in case you want to do so. And last but not the least, by all means, this is the only business which I know wherein you can make money both ways. In investing, you are just holding on to it and just waiting for the stock to go up, and you are getting some interim dividends and other benefits. But in trading, you bought a stock, it went up, you sold it, you booked a profit. When you're anticipating the stock to come down, based on your analysis, based on your studies, if you think that the stock is going to come down, you can actually go short in that stock. I'm sure majority of you would be aware about what I'm talking of when I say short selling. Correct me if I'm wrong. In case you want any kind of a any kind of a clarification on short selling, please let me know. Or can I just move on? Okay, short selling. Okay, there is one person who is asking, Mr. Krunal is asking that please clarify. Now, when it comes to trading, okay, I buy lower, I sell higher. Now, I would definitely like to buy lower when I'm expecting the prices to go up, right? But what if I'm expecting the prices to go down? Just think as an investor. You are thinking that a company called XYZ is not going to perform in next 2 years, or maybe say let's talk about very short term. Let's say that we are not going to be expecting the company to do well in say next 1 month's time. Then what do? You can't do anything till the time it comes down, and then you buy back. Okay, but in trading, you can actually short sell that particular stock in derivative segment. I'm sure you all would have heard about derivative segments, which is futures and options. Okay, and you can actually encash that downfall in a company as well. That is something called as short selling. You can even short sell a stock, an equity stock, but there is a there is a limitation that you have to cover that position in that particular day itself, but you can do a short sell over a period of time when you're trading in derivative segment. Okay, so that's what I meant when I said it's short selling. So I believe trading is the only business, as per my best knowledge, which can give money to you both ways. You take any other business, let's take real estate for that matter. When the prices are going up, everyone will make money. But what about when the prices are going down? Let's say you deal into real estate. What would you do when the prices started going down? Okay, you factually can't do anything. But in trading, you can do that, because when prices go down, you can do that short selling. Okay, and you can make money out of it. Okay, so having clarified this myth about trading, I would say to an extent, friends, let us now move and talk about that secret of success. Okay, now what is the key to success? Can anyone tell me what do you feel about it? What is that key to success? What is that key to wealth building, I would say, or financial success? Acting with knowledge, hard work, and dedication. Yes. Okay, so what everyone is of the view is, which is similar to mine, that there is not a particular key to success. It's not a turnkey project. When you do one thing and you get it. It's a mixture of everything. What we told about planning and process. If you do that, there is no particular key to success. But if you do that with a proper planning and process, the way you do it actually gives you a success. So success is something which would differ person to person. The way you do it, as a result of that, you would receive the success for it. Okay, so now let's move on, friends. And since trading comes with two added advantages. Okay, we all would have heard about investing, and it's a very passive approach. That's what I mean. Once you just have to do a proper analysis of the company fundamentally, or I would say with its intrinsic value and all, and then you can just hold on to it. There are blue chip stocks which you can just hold in your portfolio, and they would give you a lot of returns. Okay, but trading comes with that added advantage. It's some slightly extra work. Okay, but it gives you, it's worth doing that extra work, friends, because you're expecting a stock to say double in a 1 year's time. And let's talk about trading. If you expect to make 5 to 10% profit per month, which is not difficult. Let me tell you honestly, 10% profit a month comes to 120% profit per annum. And if you talk about compounding, then it even goes higher than that. Okay, so trading and investing for me, both are on equal levels. If you ask me what do, I do both of them, because both of them have different objectives. Objective for long-term investing is I'm securing my long-term future. I'm planning, I'm preparing myself for my long-term goals, like my retirement maybe, or my kids' marriage, or whatever, his studies and things like that. Okay, but when it comes to trading, I can be looking at some short-term goals. So it's not that a person needs to only do either investing or trading. He can do both by allocating specific amount of capitals to both of them. In investing, you can even do that on a regular basis with systematic investment plan. I'm sure many of you would have heard about it. Okay, so since investing is something which is a much known topic, I would be concentrating on the second way of achieving the financial success, which is trading. So let's talk about the pillars of trading when we go ahead. Okay, now here I'm not going to be giving you a rocket science. We are just going to be talking about the planning, which we discussed earlier. How do we plan about entering into the markets? Then the process. On what basis are we going to do that? Buying lower and selling higher activity. I'm sure everyone would be interested in knowing that. So on what basis we are going to be doing it? What process are we going to adopt for the same? And finally, discipline. Let's say you have decided the planning. You have done the planning. You have decided the process. Now to stick to that is called as discipline. You have to stick to it. You can't go against what you want. You have already decided what you want to do. You can't go against it. So discipline tells you, discipline is remembering what you want and not deviating out of it. Okay, so we are going to be discussing these three things. So when it comes to planning, first thing is what to trade in. Now, I'm sure that all of you would be aware that there are four segments which are majorly traded in the Indian markets. Okay, so which segment are we going to select depends on your choice, depends on your appetite, depends on your availability. Okay, first is stock market, of course. NSE and BSE, the two leading exchanges in India. Okay, and they have more than thousands of stocks which are there. Okay, you can select any of the stocks either for investing or for trading. Again, the there are two bases based on which you can achieve that success. Okay, one is investing, the other one is trading. The avenues would be, the first avenue is stock markets, wherein you can select stocks for doing it. Then sometime back we spoke about derivatives, which is futures and options, right? Which can give you that added advantage of making money both ways. If you want to go short in a particular company or in a particular stock, you can do that in the derivative segment of that stock, the derivative counterpart of that particular stock, for which the underlying asset would be that particular stock or the index maybe. Okay, and you can achieve that success with futures and options. Now, one of the kind of emerging asset class recently is the gold, silver, and as a whole the commodity segment totally. We have bullions getting traded there, which is gold and silver. We have various agri commodities getting traded over there. We have base metals like copper, zinc, and what do we say, lead, all those base metals getting traded. We have energy sector, like we have crude oil, natural gas getting traded there. Okay, in commodity markets, majority of the players can also be thinking of taking a trade. Now we all know that we are bullish on gold, or let's say that was a story from last, I would say, 5 to 10 years. Gold has appreciated from almost 7,000, 8,000 rupees per 10 grams to around 35,000 rupees per 10 grams. Now currently it's trading at around 30,000. Now how do you benefit out of it? You can buy gold and keep it in your locker, but that doesn't give you any money as such. That doesn't allow you to sell it any point of time, because the jeweler is not going to give money for you. I mean, the same money as per the market price to you when you want to sell it. So you can do that by trading in the commodity markets. And last but not the least segment, it's one of the latest entrant in the Indian markets, which is the currency. We all would have heard about what happened to the dollar, which was available at 40 rupees around 2-3 years back, if I'm not wrong. Okay, is recently trading more than 60 rupees per dollar. Now, because of that dollar turmoil, because of the Indian economy not performing so very well, our Indian rupee lost its value. It came down by almost 50%, from 40 rupees to around 60 rupees, because of that, or rather because of the trade deficit getting wider and fiscal deficit going out of control and things like that. All those things, because of which the inflation went up and all other domestic crises which we faced. Okay, if you want to make money out of it, we would have just bought dollar and rupee pair, and you would have been able to make money out of it. So these are the 4 basic segments, okay, in which you can think of trading or investing, for that matter, as per your wish. Okay, now I would say the most important thing, okay, when it comes to planning, you should plan which trading style would you adopt. Now when I say trading style, there are different people here in this session itself. We have around 20 odd people. Okay, so 20 of us would like to trade in different manner. You would say, I want to trade for a 1 day, I want to trade for, say, someone will say I want to trade for 15-20 days, someone would say I want to trade for few weeks, and so on and so forth. So let's discuss some of the popular trading styles, and then we will also be discussing as to which is the one we should be selecting out of it. Okay, so the first trading style, which is one of the most popular one, is day trading. As a day trader, you believe whatever has to be done should be done today only. Tomorrow might be too late. You don't want to wait for that overnight risk. Let's say you bought something today and there is a bad news in the markets, because of which the stock or that commodity maybe is going down, or it's opening gap down on the next day. You might lose a lot of money. So you don't want to do that. Whatever you want to do is, you want to do it in that same particular trading day, and to buy lower, sell higher. Try to do that, try to get profits, and then have a sound sleep. If it's a profit, well and good. If it's a loss also, you're not taking any overnight burden. Okay, now when it's a day trading, as the name suggests, your trade lasts, or you'll be holding on to it only for single trading session. Okay, so let's throw some light on the segments and their available trading times. So equity markets on a weekdays, they are opened from 9:15 a.m. to 3:30 p.m. Along with equities, even derivatives market also get traded for the same time period. Then we talk about the currency markets. It's a slight extended time, which is from 9 a.m. to 5 p.m. It's for around 8 hours every day on a weekday. And then finally, it's commodities, which are open from 10 o'clock in the morning till around 11:30 at night. There is something called as daylight saving. So in the winter session from around, I think, October, November onwards till around February, March, the commodity markets are even open till 11:55 p.m. And for the rest of the year, the markets are open till 11:30 p.m., which is a trading period of around 13 and a half hours. And let me tell you, friends, this segment, commodity markets, is the hot favorite of traders because majority of us would be having some engagements in the morning, maybe going to office or going to our own work or whatever the story is. But majority of us would be free in the evening time. Let's say you come back by 6:30, 7:30 also. Still you have nice 4 to 5 hours of trading time left for you if you want to do day trading in commodity segment. Okay. Now, if we call the financial success or the art of making money as a joint venture between ourselves and the market, then if we are only giving few hours to the markets to make money for you, your availability is very, very important. You need to be frequently accessible to the trading terminal. Many of people, when I take trainings, if I ask them, what would you like to become? He would say day trading. I don't want to take that overnight risk. Whatever is the story, it's the end of the day's play in that evening. Next day is altogether a new day itself. That's right. But there is a difference between what you want and what you can. Now, as a salaried person, you might not be able to take day trades in equity markets or currency markets, but yes, you can do that in commodities. So it would differ person to person. You look at what you want first of all, and then you also check whether you can do that. Okay. If you're trading based on someone else's recommendation, well and good, that's not a problem at all. But if you want to do that on your own, if you are in the driving seat, then you have to be available so that you can place the orders whenever required. Okay. Now, when it comes to trading, there are two things. One is the risk and the other one is reward. So risks, what are the risks involved? Whichever the risks are involved can be controlled with proper management. We are going to be discussing that a bit later. Okay. And then what can you expect? Of course, in one single day, you can't expect windfall gains. You can expect some small returns, and I will talk about percentage terms. You can expect 0.5% to 1% movement of that security. It can be a stock, it can be a commodity, it can be even a currency pair. You can expect 0.5% to 1% returns of that particular security. That's what day trading is. Intraday trading also, which is called as. Okay. Now let's say you would say, Hrishikesh, I'm not able to do this because I don't have that much time. When I come in the evening also I have some other work at home, or maybe I've got a kid or whatever the reason might be. Okay, then does that mean you can't trade? No, you can. You can trade for short term, or which is also called as swing trading. So any trade which has been held for more than a single day and up to 10 days, I would say, can be called as short term trade or a swing trade. Now, since you are giving a higher time to the markets, your availability automatically comes down. Remember, it's a joint venture. So you should be just accessible to the terminal, need not be in front of the terminal always. So whenever required, if it's required on an urgent basis, you can anytime just do that, and you can just place your orders. You can even call up your broker in case you hear about a news on a news channel, or maybe you read about something and you want to act on it immediately. You can just call up your broker and you can trade that. Okay, that's fair enough. That may not be possible with day trading because it's only few hours available for you. Okay, so execution time has to be immediate, which may not be the concern for short-term trading. You can just take those 5-10 minutes extra time and execute your trade. So short-term trading is done for basically around 5 to 10 days. I would say around 2 weeks time. Risks are here as well, and we can even control them by proper management. And what can you expect here? Since you are giving higher time to the markets, you can expect some moderate gains of around 3 to 5% of the price of security. It can be stock or it can be commodities, as I said earlier, but 3 to 5% of that particular security you can expect when you're trading in short term, when you're trading for a few days. And then last but not the least, positional or medium term trading. You want to take trades for, let's say, 2 to 3 months. A trade for a few weeks can be called as a positional trade or a medium term trade. Now, since you are giving that much of time to the markets, you are almost giving 1/6 or 1/4, I would say, of the entire year to the markets to make money for you. Your availability is not that required. You can just occasionally see the prices, just check in which direction your trade is going to, and what are your profits or what are your losses, and is everything in control, and that's it. If you can just look at it even once or twice a day, maybe before going to office in the morning and maybe after coming to office at night, if you can just do that and place your orders properly, okay, and be in touch with your broker on the phone in case you can't access it in your office or your workplace, then that's fine enough. The risks are controllable in positional trading, and profits, of course, because you are giving around 2-3 months to the prices I mean 2-3 months to the markets, you can expect some high returns of around more than 5 to 10%. Now friends, I have told you about the returns in terms of the price movement. So 0.5% to 1% for intraday, around 3 to 5% for short term, and around 5 to 10% or more maybe when it comes to medium term. Okay, I'm not saying that's the limit. I'm saying those are the average returns which can be expected when you're trading in that security. Now, if you're trading in something derivatives, which we all know that it's a leverage product, you get a lot of leverage with a very small capital. You can actually enter into a very big position. So if you're doing that, then your profits are really huge. I just don't want to extrapolate stuff, but let me just tell you, I only told you about the price movement in percentage terms. Your actual profit which you're getting in your account can differ based on the instrument you select. If you select derivatives and options or futures maybe, then of course it can be a real good profits which you can see. Okay, so these are the two things, friends. One is what to select and what segments would you trade or you invest, and then if you are trading, then what time for which you would be devoting to the markets. So your trading style, selecting it would depend less on the markets, I would say, and more on your availability, what you want, and as I said, what you can. If you can't do day trading in equity markets, doesn't matter. If you can do that, you can just spare that time in the in the evening time after you're coming from your office, then you can do that in commodities. If you can't do that at all, you can have short-term trading as an option for you. You have the positional trading option open for you. Okay. Now moving on, friends. Let's discuss now the process part. We looked at the planning part. Now let's look at the process part of it. Basis of trading. On what basis we are going to be trading. Now we already know on what basis we invest. I've already clarified that. You look at the fundamentals of the company, you got, you have, what do we say? You have the profitability of the company, the future prospects, the management performance, and, debt equity ratio, and a lot of financials are involved and things like that. So that is something for investment. That is something which we look at as fundamentals, wherein we look at all these factors. Now, fundamentals may not help you in taking a trade for, say, a time frame of 1 day or maybe even 5-10 days. Of course, if there is a news announcement, if the reports or maybe the quarterly results are awaited for that particular stock in next couple of weeks, yes, you can expect that as well. But usually, okay, you can't trade based on fundamentals. I mean, you can't trade, or you can't do that buying lower and selling higher activity by only looking at the fundamentals. Okay, there is something else which is required. We'll be looking at that. Okay, that is sentiments. Okay, so that one is fundamentals, which includes all this profitability and things like that. Then it's news. You would have been getting news by various sources, on news channels, on papers, or maybe from your friend circle, and also you know that when there is a good news in a particular stock or a commodity or maybe a security, you can think of buying opportunities and vice versa. But usually, let me tell you my own experience, this is a delayed version. This comes with a lag. When you get a news of a particular stock, when you open the terminal in order to trade, that news is already had affected the prices. If there is a good news, the prices would have already gone up. If there is a bad news, then the prices would have already gone down. That's what is regularly, I would say, seen. Okay, so yes, you can do trading based on news, but that comes with a certain lag with it. Okay, it comes with a delayed delayed way, I would say. Okay, so then what is the basis of trading? I again come back to the sentiments, the emotions, greed, fear, and hope. When there is a bullish sentiment, when there is a bullish mood, you can think of buying opportunities. When there is a bearish sentiment, you can look at selling opportunities. Okay. And you would say, Hrishikesh, is that easy? No, I'm not saying it's easy, but at the same time, I'm also saying it's not difficult. There are ways to do that. Now, one of the best ways which I follow, okay, and I teach also, okay, is definitely technical analysis. I have been told that majority of you have completed your entire curriculum and you have two basic modules on it. One is for basics and one is for advanced, if I'm not wrong, on technical analysis, right? So technical analysis, why I believe onto it, can I ask any one of you here, okay, as to meaning why technical analysis can be good? Now this is my view, it might not be your view, that's fine enough, but why do you think that technical analysis, okay, is good, or what is technical analysis basically? First, history-based trading, and secondly, price movements in form of graphs. Okay, show past trends of price and volumes. Okay, anything else? Because of price patterns of stocks repeat, you can trace using technical analysis. Okay, okay. Now let me tell you why I like it. Okay, now I'll ask you, if there is a good news or there is something good about a particular security, it can be commodity or it can be currency or it can be any stock for that matter, what would happen? In the markets, what would happen if there is a good news or something good about a particular stock? What's likely to happen in that stock on the next day when the prices open, when the markets open? Let's say Reliance comes out with a very good numbers, very good quarterly results, okay, and there is a lot of bullishness in that particular company. So what would happen on the next day when the prices open? Ideally, the prices should go up. Is everyone with me? Does everyone agree? That prices would go up when there is a good news and prices would go down when there is a bad news, right? So why I like technical analysis is because technical analysis studies the price itself. It believes that whatever happens to the price. So let's study the price and let's study the price only. Price discounts each and everything which happens. That's what technical analysis is. There are various ways by doing it. There are, as many of you mentioned, there are studies, there are price trends, there are there are various patterns to understand. We are not getting into that here because I'm sure you have already would have heard about it, okay, or know about it. But technical analysis basically allows you to determine the trend. So you know when the stock is in uptrend, you can think of buying opportunities. When it's in a downtrend, you can look at selling opportunities, and so on and so forth. So indirectly, it helps you to gauge the sentiments, to understand what are the sentiments behind the price action. Are they bullish or are they bearish? And then accordingly, you can take that trade. Because remember, trading is done for basically short term. When you compare that with investing, which is for 5-10 years, you don't trade for 5-10 years. It's not good to do that. You can do that for maybe few days to few weeks, as we discussed, okay. And for that, these sentiments, they really do a good job of understanding where the prices are likely to move for that particular security. Okay, so these are going to be the basis of trading, the process which we can follow. There can be n number of rules, n number of strategies and setups, okay. In case you have doubts regarding anything, you can ask me now, or maybe you can even ask me in the question answers. That's not a concern. Okay. Now let's move on, friends, and talk about that last pillar, discipline. Okay. Now what is discipline all about? We already heard discipline is remembering what you want, and when it comes to doing that, I think trade management is the must. If I just draw a pyramid of whatever we discussed in the form of pillars of trading, I think the top of the triangle would be of what do we select and what segment and what trading style do we select. Then comes to the process. Which process do we have? Which indicators would we use? Which patterns would we follow and all? And then the base for the entire structure, that strong foundation, is offered by something called as trade management, money management, as we all know it. Okay. Now, as a trader, you have an edge over the investor. I would just like this question to all of you. What do you think? What is that edge? What is that plus point for a trader which is not there maybe with an investor? Can anyone tell me that? It is just a friendly question to all of you. Okay. There are no answers yet. Okay. Let me just tell you, the edge when you are trading is that you can limit your risks. Just think of it. 5-6 years back, when the markets have actually collapsed, there were stocks like Unitech, DLF, majority of the real estate companies who were trading in hundreds and thousands of rupees. Yesterday, I don't know how many of you have followed the market, but yesterday markets were really gone up like rocket. They are trading at their lifetime highs now, Nifty and Sensex both. Sensex is close to 22,000, Nifty is above 6,500 levels, okay, which is the higher level as compared to 2008 highs as well. But all these stocks are still not at the rate, they are nowhere near at those rates of 2008. When you are trading, you can limit your losses, and I believe the edge for a trader is something which we know as stop loss. Okay, how many of you are aware about stop losses? Do I have to explain that as to what do we mean by stop loss, or can I just move on? Have you all heard about something called stop loss? There is some problem. I'm not able to see your questions in one order. Okay. Okay. I got it that you all know about stop loss, right? So many of you are saying, please explain. Let me just give you a small brief explanation. Let's say you bought something, okay, at say 100 rupees. Based on your indicators, based on your studies, you know that if the prices go below a particular level, let's talk about in technical terms. I think all of you would have heard about supports and resistances, price bottoms and price tops. So let's say you know that if the price bottom is broken, then the stock price is going to go down further. So you limit your stop there, you limit your loss there, you stop your loss there, and that's what is called as stop loss. So let's say you buy something at 100 rupees, and you know that if prices go below 90 rupees, they can go further down. So you're taking that chance by buying it at 100, putting your stop loss at 90. So your risk is limited to 10 rupees per share. That's it. You're not going to be losing anything. Even if that stock goes down and becomes 50, it becomes half in that entire turmoil. If something like that repeats in the markets again, then also your your loss is going to be limited to the 10 rupees for which you had put a stop loss in the order. Okay. Now friends, after having discussed that edge, let us now come to, I have been talking about, discipline is sticking to what you want. So we have to first decide what we want, and for that, what can we afford? So what we want is definitely we want profits, we want reward, and what can we afford for that is in market language called as risk. Risk simply means a difference between entry price and stop loss. Let's say you bought something at 100 with a stop loss of 90, your risk becomes 10 rupees per share. You bought gold at 30,000 with a stop loss of 29,000, your risk becomes 1,000 rupees per lot of gold, because gold is traded in derivatives. It's not traded, in grams and all. It's traded in form of derivative contracts. Okay. Okay. So risk. Now, having said about risk, I think the most important thing, if you take nothing out of this training, if you take nothing out of this entire seminar, okay, and you only listen to me for last slide of my presentation, I think that's sufficient enough. Okay. How much do you risk? And that is the question, I believe. Even if you are investing, there is risk involved. If the company does not perform well, like what happened with the real estate sector or what happened with the telecom sector. That's the risk which it's very difficult to measure. In trading, you can actually measure that risk. You can decide the risk what you want to take when you're taking a trade. So when we talk about deciding how much should I risk, that is called as position sizing. Position sizing is an answer to the question, what should be the trade size? Okay, now let's take this example maybe. Okay, let's say Reliance, as of now, I'm not looking at the actual price, but let's say Reliance trading it at 900 rupees. You, by doing all your analysis based on technical indicators or anything else, maybe you know that Reliance is going to go up to 1000. Okay, and for that you have arrived at a stop loss of say 850 rupees, and your target is going to be 1000 rupees. Oh, that's too much. Sorry, it's 1000, not 10,000. Okay, so here you know that your risk is going to be 50 rupees per trade. Now, let's say you have a capital in your trading account of 1 lakh. You can roughly buy around 100 shares. Is everyone with me? Okay, you're going to be buying around 100 shares. Now, understand your risk. Your risk is 100 into 50. Your risk is going to be 5,000 rupees. Now, what you have to do is decide whether you're comfortable with it or not. Know your limits. Take a calculated risks. We all know, at least in bookish language, that in capital markets money can be made, and that is why we all are here. I'm very sure about it. But yes, those rewards can be made, that money can be made, provided you know how to take that calculated and well planned risk. You have to know your limits when you want to take a trade. Now, limits can be in different formats. One is, what should be your per trade loss? Now, if you ask me, Hrishikesh, what is your per trade loss? Now, when I take a trade, it depends based on the trading style. When I take intraday trade, I don't risk more than 200 rupees. Now, you would ask me, Hrishikesh, why? The answer is, that's because it's my trade and I'm comfortable with 200 rupees. I'm sorry, not 2000. I'm comfortable with 200 rupees. There is no reason for it. This is my comfort zone. Friends, we all know that in markets, it's all about the game of emotions. It's the game of, it's like you are trading emotions when you are trading in the markets. And it's factually proved that you cannot control your emotions. There are 60,000 thoughts which come to your mind, and it's going to be very, very, very difficult, to control all these thoughts. Okay. I believe by doing this, by knowing your limits first and then taking that calculated risk, not deviating from that, not going above it, okay, you have a great chance, I believe, of controlling your emotions. Now, there are many people who will talk about, not risking more than a certain percentage of your capital. Now, I also will do that. There is a risk is, if you're trading in equity markets where you don't have any leverage, you don't risk more than 1 to 2% of your capital in a single trade. When you're trading in a leverage product like derivatives or options, maybe you don't risk more than 5% of your capital in a single trade. Okay, but why I'm not saying that is not right or that is not good. What I mean is, now let's say many of you would say, okay, Hrishikesh was talking sense, let's start trading. Okay, and then let's say those professionals out here, we already are nearing the financial year end. Okay, financial year is getting close now. So maybe you are getting a bonus and you're putting that bonus of 1 lakh rupees for trading purpose. Let's take an example of it. Okay, now you want to take that trade. 1% of that 1 lakh, let's say you're taking a short-term trade or maybe an intraday trade, 1% of that 1 lakh is 1000 rupees. That's a mathematical rule. You have to be comfortable with those 1000 rupees. You can have a bigger capital, you can have a smaller capital, you might be comfortable with 1000 rupees, but what about if you have a capital of 10,000? Are you going to be losing 10% of your capital? That's not also right. So first decide the comfort zone and then take a trade. Now, what happens if you don't do that? Let me put that point very clearly. What happens if you don't take a risk with which you are not comfortable? It kills you both ways. Meaning, if you take a trade, let's say my comfortable risk, I was comfortable with a risk of not more than 500 rupees. Okay, so I have to take only 10 shares of Reliance instead of 100 shares. But because I heard good news about Reliance, and then many people also told me that, even my broker told me that it's going to go up and it's looking very good. So why don't you buy 50 shares or at least 100 shares? If I do that, if the prices start going against my direction, against my desired direction, I get panic and I might book my loss before my stop loss gets triggered. And remember, then we are deviating the rule of discipline. Discipline is you have decided and you're going to be following that decision. They always say, it's planning your trade and then trading your plan. Planning your trade is very easy. Trading your plan depends, I would say, on this factor. Because you're not comfortable with the risk which you took at the beginning, you might be baffled when prices go against your direction. You would say, "Nahi, forget it. Let's not wait till stop loss. Let me just take out. Let me just sell off whatever shares I bought, because if I hold it till stop loss, I might lose 5,000 rupees. I don't want that." And even if it's going up, you're actually buying that with a target of 1,000 rupees. Once it goes up to 920, 930, you would say, "Yeah, okay, I bought 100 shares. I'm getting 2,000-3,000 rupees. Why not to book it?" Then you are again deviating from your rule of discipline. You have decided to take a risk of 50 rupees for a reward of 100 rupees, which is a nice risk-reward ratio. We all know that. Risk-reward ratio is something which I don't have to explain. It should not be less than 1:1. It should be always greater than 1:1. 1:2 being a very commonly followed one, and higher the better. So you have decided that trade by risking 50 rupees for a target of 100 rupees. If you're just booking a profit in 20-30 rupees, you're again deviating from that rule of discipline which you decided while taking the risk-reward ratio in consideration. Okay, so it actually kills you in both manner, in term, meaning even if it's going against you, you get panicked, you get fearful. And when it's going in favor of you, that is also the time when you get fearful, you get panic, and you want to book some small profits without waiting for your actual rule which you had decided. So you have to decide a per trade loss. Now, for those who want to take part in day trading, or even I would say short-term trading, you also have to decide daily loss limit. Now, we have decided a process based on which you are going to be trading. Let's say the process involves indicator like relative strength index, or maybe indicator like super trend, or indicator like MACD and all. Okay, any of it. You have decided it. Now, maybe on that particular day that is not working. That's not the end of the world. It's not that if that doesn't work on a single day, you have to get really demotivated about it. Now, but what happens as a trader is you take first trade, you make a loss. You take second trade, you make a loss. Third trade is a loss again. Then what happens in the fourth trade? You want to recover all those losses which you made in first three trades, and that's when you actually change your rules. You start risking more money because you want that one trade to give you complete losses which you gave to the markets in first three trades. So then you deviate from discipline, and then what happens? Maybe that day is not good for you, so that fourth trade also goes into a loss, and then you think that trading is not good. It's just gambling. It is just like speculating. Yesterday I made money, today I'm losing money. Yes, you are losing money, but the success lies in limiting your losses and maximizing your gains. That's what we do about, that's what we do in risk reward. When we decide the risk reward, we know, okay, if I take 100 trades, out of which, let's say even 50 I'm profitable, in 50 I'm loss making. But when I'm losing in those 50 trades, I would only lose 1 rupee each. But when I'm gaining in those remaining 50 profitable trades, I will make 2 rupees. So even if you're right, only 50% of the time you can still make money. That's what trading, trading is all about. So you have to decide that daily loss limit, after which you are just going to shut down your computer and relax. If required, you are going to be just revisiting your process and checking if you done something or the other wrong. Okay, so daily loss limit, and of course, if you're taking a day trade, intraday trade, please don't take too many trades. I think 5 to 6 trades, that is sufficient when you're taking an intraday trade. You should not have anything more than 3 to 4 trades open at a particular time. Then you can take next trades maybe after closing the previous trade. That's not a problem. Okay, so these are the things, friends. Deciding the trade size and knowing your limits, where you should stop and what you should risk and what you should not exceed, the number of trades or the loss for that particular day. So in this entire session, friends, I would say the first pillar which we discussed about selection of trading style and selection of segment, and this last thing about deciding how much to risk and what to expect from the markets. Those two things is something which I would say are the most important ones. The process would differ person to person. Some of you would follow trend following technique, you would follow moving averages, some of you would follow relative strength index, some of you might follow some other thing, so the process would differ person to person, and that process is really not that important once you're 2 out of the 3 pillars are really very, very strong. Okay, friends, so let's sum it up as to whatever we discussed today. Okay, we first discussed the financial success with capital markets, and then we discussed that there are 2 ways for doing it, which is trading and investing. Trading is buying lower, selling higher. It's the business which makes money for you both ways. You can even short sell and then buy it back later. And then of course there is investing. And I'm of the complete view. If you ask me also, I am an investor and I'm a trader also. So you can do both the things simultaneously. Okay, with different objectives, short term and long term. Then we also clarified a myth about trading, that trading cannot be done for wealth building. We also looked at some people like Mr. Richard Dennis, Mr. Bill Eckard and all, okay, who actually get their bread and butter based on trading, and they're really wealthy as well. Okay. Then we looked at the edge for a trader. As someone said rightly, yes, the edge is that it comes with an added advantage of that short-term liquidity, which is not there in the investments. And also, the short-term liquidity comes because you can do something which is called as stop loss. If the prices are not doing what you want them to do, you just get out of it when you think that it's not good to remain in that stock. If you don't do it, friends, then I think trading is really a sin, I would say. If you don't trade with a stop loss, that is as equivalent to, committing a sin. That's what I believe. Okay, and then finally we looked at some pillars of trading, which we call as secret to success. It was not a secret as such. It was not a rocket science. It was just, that's what I said. My session was all about, we all know what to do. I was just about to, I was just trying my level best to tell you how do we do it. Okay. So with that, friends, I would say thank you very much. And thank you for your time. It's already, I think, 1 hour, and I would say that the session is over. Thanks a lot for your time here. If you have any doubts, if you have any questions, please let me know. I've given my email ID. Trisha would be mailing you this PPT. Okay. She would also be mailing you the recording of this in case those people who could not join from the beginning. Okay. We would be also mailing the recording of it. You can just ask Trisha for that. I will be uploading the recording. Okay. There are a lot of questions coming in. Okay. Can you please paste the email ID again? It's there on the screen. I will just put it in the chat box. It's prishikesh@hotmail.com. That's my email ID which I usually use. Okay. Okay. What is the pre-open session? There's a question from Shivanandam. See, pre-open session is a session which starts at 9 o'clock on a day when the markets are going to open at 9:15, and it's there till 9:08, meaning 8 minutes past 9. In that, the order matching happens. Now, if you ask for me as a trader, that's of no use because you can't actually place an order and get it executed. You can just place those orders which are going to be getting executed after 9:15. If you ask me if I do that, I really don't do it. I think I've already given my mail ID. If you have any queries, please let me know, friends. Please feel free to ask the queries right away. Even about something about trading, or maybe the process of trading, in which we discuss technical analysis in a bit more detail. If you have any doubts, because I do take training sessions for technical analysis and the complete process of it. So let me know if you have any doubts. Otherwise, I would say that the session is over and you're free to enjoy your weekend. Thank you. Thank you very much. Thank you. Thank you very much, Nikhil, for saying that the class was very informative. Thanks a lot. Thank you very much. And I hope that we meet sometime afterwards. Okay. So having said that, okay, which indicator more useful in technical analysis? Mr. Sivanandan, if that answer any of us knew, then none of us would be in this training session. That's what I said. It's not one indicator. It's not one key to success. And when it comes to technical analysis, I always believe it should be a group of indicators, because when you're trading, when you're investing, whatever it may be, I just believe that it's the game of probability. You are just looking at increasing the probability for you to make money, for you to be successful. Okay. So if you ask me which is the indicator we should always use, I would say the supports and resistances, the price bottoms and price top. That is something which I always use in each and every trade, but not only based on that. I don't only take trade because it's at a support. Along with that, I would also use other indicators. My favorite indicators are, of course, candlestick patterns. I use relative strength index, and I also use an indicator called as super trend. Okay. Anything else, friends? Okay. Thank you. Thank you very much. Thank you very much, everyone, and hope to see you all soon. Till that time, it's bye from Hrishikesh. Bye bye and take care. Happy money making and happy wealth building to all of you. Bye bye.